Over the past year, PayPal is up by more than 50%. The company currently gets a strong buy rating from the quant, a buy rating from Wall Street, and a buy rating from the SA analysts. Now, to be fully transparent, I do currently own PayPal in my portfolio. I first bought it at the start of 2023 when it was trading at about $80 a share. For the second time, I bought it when it was trading at about $70 a share, and for the third time, I bought it at its all-time low at about $56 a share. But now let's figure out if at its current trading price the company is still a buy. So jumping to my stock valuation spreadsheets, I have already plugged in PayPal sticker and all the metrics have shown up automatically. And as always, if you want to download these spreadsheets for your own personal use, you can do so at the link in the description. Now, the first thing we can see is that PayPal currently doesn't pay out any dividends whatsoever. Now, what you have to understand is that sometimes, even if your main goal is to invest into dividend companies and one day live off dividends like it is mine, an opportunity like PayPal might show up that is just too sweet to miss. They currently don't pay me any dividend, but they have grown my investment by a lot. And with the digitalization we are currently experiencing, I do actually believe that PayPal will at some point start paying out a dividend. Because when I jump to the 9-pillar analysis, you can see that the 5-year free cash flow CAGR is sitting at 9.35%, which means that every single year, PayPal has been increasing their free cash flow at a rate of 9.35%, which is awesome. Now, currently they are using their free cash flow mainly to innovate and to acquire other smaller businesses, which is growing the company's value. They are also using it to decrease their shares outstanding at a nice high rate of 2.29% yearly, which as well in the long term increases the value of my investment. Now, when I zoom into pillar 7, the decreasing shares outstanding, something I love about PayPal is that they weren't just blindly repurchasing shares when they were trading overvalued. You can see that in 2021 and 2022, the share repurchases were minimum, while in 2023, 2024, and over the past 12 trailing months, the repurchases started to grow and by a lot. If I jump back to the stock screen and plug in the days change at 1,500, that is about 5 years, you can see that in 21 and 22 they were indeed trading very expensive, and then when they bought back most of their shares they were actually trading really undervalued. So a very smart play by PayPal, not wasting their free cash flow. Now, something I also love about the company is that they have very low debt. If you have a look at their long-term liabilities over their 5-year free cash flow, that ratio is sitting at only 0.57, which is well in the range we would like it to be in, and means that PayPal would take only about 3 years to pay off all their long-term liabilities with the free cash flow they are currently generating. Now, I haven't yet mentioned that the rating of the company is sitting at 6 out of 8, with 2 pillars currently in the red, and these are the 5-year PE ratio and the price to free cash flow over the past 5 years. Now, if I zoom into pillar 1, that is the 5-year PE ratio, you can see that PayPal has actually been pushing it down very nicely over the past 5 years, and currently it is sitting at 21.50, which is much lower than the 5-year average and is actually in the range we would like it to be in. So that means that PayPal might currently be undervalued compared to the earnings they are generating. Now, let's also have a look at the price to free cash flow, which, as most of you know, I do find more important as the PE ratio, as the free cash flow is essentially used for everything while the net income is just a measuring metric. And the free cash flow has actually also been declining over the past 5 years, and currently it is sitting at about 23.65, which is lower than the 5-year average, but higher than the average stock price to free cash flow. So PayPal might be slightly undervalued compared to the free cash flow they have been generating in the past, but not so much compared to the average stock price to free cash flow. But jumping back to the 9-pillar analysis, we still have 3 more pillars to go through, and that is the revenue growth, the net income growth, and the 5-year profit margin. We can see that the 5-year profit margin is sitting nice and high at 14.58. If I zoom into pillar 6, we can see that it has been fluctuating a little over the past 5 years, but it has for most of the time been sitting above 10%, so that is great. And regarding the net income and revenue growth of the company, their 5-year net income CAGR is sitting at 21.59%, and their 5-year revenue CAGR is sitting at 12.26%. If I zoom in closer, you can see that indeed the revenue grew from about 17.7 billion in 2020 to 29.7 billion in 2024, and that is the similar case with the net income, which grew from about 2.5 billion in 2020 to 4.2 billion in 2024. So PayPal has been performing some great growth in their net income, in their revenue, and in their free cash flow, which is very important, as most of the times the stock price growth of a company is based on their profits growth. And so if PayPal continues to grow at these rates into the future, they will also have a nicely rising stock price and therefore grow your investment. And now that we have gone through the 9-pillar analysis, let's also calculate the intrinsic value of the company, first using the grams formula revised. And here we have to plug in the 5-year earnings growth estimate. And to do this, first I have to plug in the high earnings per share growth estimate, which I plugged in at 15. I plugged in the medium at 10 and the low at 8. And combining this with the analyst projections, I will get the 5-year earnings growth estimate at almost 10% every single year into the next 5 years. Now, when I combine this with the other values, I will get an intrinsic value of $67.04, which is actually 30% lower than the current trading price. Now, the reason for this is that the current yield on AAA corporation bonds is much higher than the short-term average. When I jump to the AAA corporation bonds graph, you can see that for most of the short term it has been moving at around 3.5 and only currently did it jump to around 5. So when we plug in the short-term average of 3.5, we will get an intrinsic value of $97.30, which is actually 8% higher than the current trading price. Now, for the second evaluation model, we will take the free cash flow of the company over the past 5 years and calculate the growth rate to be sitting at 9.35%. Now, I do believe that in the future PayPal will grow at a slightly faster rate, so I predict a growth rate of 11.7%, and using that I will calculate the future free cash flow. Now, to calculate the present value of that future free cash flow, I plugged in a discount rate at 9.6%, and then summed up all of that future free cash flow, added cash and cash equivalents, and subtracted total debt, and got an equity value, which I divided by the shares outstanding, and got an intrinsic value of $122.26. Now, for the third valuation model, I want to compare PayPal to 3 of its competitors. I took these competitors' current stock prices and divided by their earnings per share to get their PE ratios. And we can already see that these competitors' PE ratios are higher than the PE ratio of PayPal. And so when we average them out and multiply them by the earnings per share of PayPal, we get an intrinsic value of $127.84, which again is higher than the current trading price of the company. Now, normally we would go through the dividend discount model, but as PayPal currently doesn't pay out any dividends, we will skip this one and arrive straight to the ultimate valuation, where when we average out the 3 valuation models, we will get an intrinsic value of $115.80, which is about 30% higher than the current trading price. And with a margin of safety of 20%, we would get an acceptable buy price at $92.64, which is slightly higher than the current trading price. So overall, it seems like that even though PayPal rose by 53% over the past year, they are still undervalued and still have potential to grow further. And with that, make sure to leave a like and subscribe, as it really helps me out.